Welcome to the Maybe Not So Great Books channel, You Decide. This is lesson 12 of 14. How Companies Lie with Earnings. The accounting chapter you must read. From The Intelligent Investor. The definitive book on value investing by Benjamin Graham. Commentary by Jason Zweig. Every quarter, companies report earnings per share. Graham says it's the most manipulated number in finance. Here's how to see through the lies.
It's quite a bold claim right out of the gate.
Yeah, it really is.
To just flat out say that the single most watched number on Wall Street, the number that moves the entire market, is basically the least reliable.
And it feels almost, blasphemous to say that out loud. Because we live in this world that is just totally governed by earnings season. It's a ritual for us.
Oh, absolutely.
Turn on the financial news, and it's like the Super Bowl happening 4 times a year. You've got the Chiron scrolling at the bottom of the screen, the countdown clock's ticking down to 4 p.m. Eastern.
Wait, I'm almost holding your breath.
Right. It's all about the beat. Did they beat expectations? Did they miss?
And the market reaction is just instantaneous.
Exactly. The stock jumps 10% or tanks 10% in mere seconds. Algorithms are trading on that number before a human being has even read the first sentence of the actual press release.
Yeah.
It feels like the ultimate scorecard. You get an A on the scorecard, the stock goes up, you get an F, you get crushed.
It definitely feels that way. But that is exactly the trap. What Benjamin Graham is arguing in chapter 12, which, by the way, has this incredibly dry title.
Oh yeah, what is it?
It's called Things to Consider About Per Share Earnings.
Wow. Thrilling.
Right. So most people skip this chapter. It looks boring. It's full of accounting terminology. But I would argue this is actually the detective kit of the entire book.
The detective kit.
Yeah. If you don't read this, you are walking into a crime scene without a flashlight.
I like that. A detective kit. Because usually when we talk about investing, we talk about, growth or innovation.
Visionary management.
Right. We don't talk about forensic accounting. So let's unpack this crime scene. The premise here is that earnings per share, or EPS, isn't a hard fact. It's not like the temperature outside. It's what? An opinion.
Precisely. It is an opinion. And often it's a highly manipulated opinion. You really have to understand that in accounting, there are very few hard facts other than the actual cash balance sitting in the bank.
Okay.
Almost everything else involves judgment calls, depreciation schedules, inventory valuation, reserve allowances. Graham's core warning is that corporate management has a massive incentive to use those judgment calls to smooth out earnings.
Because they want the line on the chart to just go up and to the right, steadily.
Exactly, a perfect 45-degree angle.
Because investors hate volatility.
Right.
We pay a premium for stability. If a company makes $1 billion one year and then loses $1 billion the next, the stock price is going to be all over the place. But if they make a steady $100 million every single year, Wall Street loves them.
Wall Street adores them.
Yeah.
But real business is volatile. Real business is messy.
Stuff happens.
Right. Factories break down. Customer tastes change. Pandemics happen. So to bridge the gap between that messy reality and the smooth chart investors demand, management uses this whole bag of accounting tricks.
So we are going to learn how to spot the tricks today. Let's start with the one that drives me crazy personally. It's this phrase I hear all the time, the one-time charge.
Ah, yes. The recurring, non-recurring charge.
Yes. It sounds like a total oxymoron. If it's one time, it should happen once. Like, hey, we had a flood in the warehouse.
Right.
Okay, that's a one-time event. But you see these companies reporting these extraordinary costs every single year.
This is the hook for this entire lesson, and it is the oldest trick in the book. Graham and Jason Zweig in his modern commentary, they really tear this apart.
So how does the logic work? Or at least, how's it supposed to work?
Well, the logic is supposed to be, okay, we had a factory fire. Or we settled a massive, once-in-a-lifetime lawsuit. That is a one-time event. It doesn't reflect the future profitability of our core business. So management says, ignore that cost. Look at our core earnings.
Which, it sounds reasonable in theory. If I'm trying to predict how much money you'll make next year, I probably shouldn't count the fact that your factory burned down this year. That's not going to happen again. Hopefully.
In theory, yes, it makes sense. But in practice, Wall Street has turned this into a complete magic trick. Companies started claiming extraordinary losses for things that are actually just part of doing business.
Like what?
Restructuring, inventory write-downs, laying off staff. If you are restructuring every year or every 2 years, that is not an extraordinary event.
No, that's just a hobby at that point.
Exactly. That is a business strategy. That is the cost of you failing to run your business efficiently.
It's like me saying, well, if you ignore the fact that I spent all my money on rent and groceries, I actually saved a lot of money this month.
That is exactly it. You are excluding the costs of staying alive. And there's the fancy term for this that usually intimidates regular investors: pro forma.
Oh yeah, you see that in the press releases all the time. Pro forma earnings.
Right.
It sounds very Latin and official, like it's been blessed by the Pope or something.
It's Latin. It essentially means as a matter of form, but Zweig notes that in Wall Street practice, pro forma essentially means earnings before the bad stuff.
Earnings before the bad stuff.
Yeah, some cynics call it EBBS, earnings before bad stuff.
EBS. I love that. Let's dig into how dangerous this actually is, though.
Yeah.
Because it allows a company to report a massive profit in the headline, while in reality, like in their actual bank account, they lost money.
It's wildly dangerous.
Yep.
Zweig uses a devastating example from the dot-com era to illustrate this. A company called Inktomi. Do you remember them?
I do. They were sort of the search engine before Google really took over the world. They provided a lot of the huge infrastructure for the early web.
They were a massive darling of the market. Everyone loved them. Now, in one specific quarter, Inktomi reported a pro forma profit. They put out a press release saying, hey, we made money.
Okay.
But to get to that positive number, they excluded restructuring costs. They excluded marketing expenses. They excluded the actual costs of running the business.
Oh, wait. They excluded marketing expenses. How is marketing a one-time charge? You have to market your product to sell it. That's like a restaurant excluding the cost of the menu.
It's completely absurd. If you looked at the GAAP number, the generally accepted accounting principles, the official rulebook number, they had actually lost millions of dollars.
Wow.
So the headline says profit, but the bank account says loss.
And that is the absolute hook for this entire deep dive. How can a company lose money in reality, but report a profit to the public? By using pro forma math to just exclude the things they don't want you to count.
Exactly. And Graham wants you to look at the bottom line, the real bottom line, not the one management invented in a boardroom.
It's not just about fooling you either, right? It's about anchoring expectations.
Yes, anchoring is huge here.
If they can get the analysts to focus on the pro forma number, that becomes the consensus estimate. Then, when they beat that fake number, the stock goes up. It's a game where they move the goalposts to the 1-yard line and then celebrate kicking a field goal.
That's a great way to put it.
Okay, so that's the trap. That's the high-level game. Let's get into the mechanics. If we're the detectives with our kit, what are we looking for? What are the fingerprints?
So the core concept is earnings manipulation. Graham's thesis in Chapter 12 is that management wants to keep the stock price high. Real business is messy, so they use what Graham calls accounting gymnastics. We can break this down into 3 main gimmicks.
All right, hit me. Gimmick number 1.
Special charges. We touched on this with the factory fire example. But there is a specific version of this called big bath accounting.
The big bath. That sounds hygienic, but I suspect it's not.
It is definitely dirty. Imagine a CEO knows they are going to have a bad year. Maybe they missed their sales targets, the stock is already down. Or maybe a new CEO just took over and wants to blame the last guy.
It sure happens all the time.
So they say, you know what? Let's make it a terrible year.
Right, why would they want to make it worse?
Because if you're already going to miss the target, you might as well miss by a mile and clear out all the garbage at once. They write down everything they possibly can. They pay severance, they close factories, they prepay future expenses, they flush all the bad news into this one single year.
So they take just a massive historic loss.
A historic loss. But here is the genius of it. Because they prepaid expenses and cleared the decks, next year's earnings will look artificially high.
Oh, wow.
They reset the bar so low that they can easily jump over it.
I see. It's pure expectations management. They come out next year and say, oh, last year was a disaster, but look at this incredible turnaround.
Exactly.
But in reality, they just shifted the costs around.
Yes. So if you are looking at a stock and you see a company taking a special charge 3 years in a row, or a massive write-down, followed by a miraculous recovery the very next quarter, you need to be highly suspicious.
Got it. If it happens every year, it's just the cost of doing business. It's not special. Okay, what's gimmick number 2?
Revenue recognition. This is pulling future sales into the current quarter to hit a target.
This is the stuffing the channel thing, right? I feel like I hear about this with consumer goods companies a lot.
Exactly. Stuffing the channel. Let's play it out. Let's say it's March 30th. You're the CEO. The quarter ends tomorrow. You are going to miss your earnings target by a penny.
Just a penny.
Just a penny. But if you miss, the stock crashes and you don't get your bonus. So you call up your biggest customer, say a big national retailer, and you say, hey, I know you usually order 1,000 units a month. If you buy 6 months of inventory right now, today, I'll give you a huge discount, and I won't even bill you until July.
So the retailer says, sure, I'll take the discount. I was going to buy it anyway eventually.
Right. You book the sale today, March 30th. You hit your target. You get your bonus. Everyone is happy.
But you've essentially stolen sales from the future. You've hollowed out your next 2 quarters.
And eventually that catches up with you. The next quarter comes and nobody is ordering because they have a warehouse full of stuff you sold them back in March.
So what do?
You have to stuff the channel even more just to stay flat. It becomes a total addiction.
It's borrowing from Peter to pay Paul, but you're both Peter and Paul.
Exactly. And the third gimmick is the one Graham hated the most.
All right, what is it?
This is the invisible one, dilution. Specifically through warrants and stock options.
Okay, we need to spend some real time here. Because when I hear stock options, I think of incentives. We want management to own stock, right?
Yeah.
We want them aligned with us as shareholders. I mean, in Silicon Valley, stock options are how everyone gets paid. Why does Graham hate this so much?
Hate is almost too mild a word for how he felt. Graham, in chapter 16, which Zweig cross-references heavily in this lesson he calls stock option, warrants a near fraud, an existing menace, and a potential disaster.
Wow, near fraud. Tell us how you really feel, Ben.
He did not mince words. And the reason is simple arithmetic, but it's often hidden from the average investor. Imagine you own a pizza.
I like where this is going. I'm always ready for a pizza analogy.
It's an 8-slice pizza. You own 1 slice. That is your share of the company. Now, management wants to pay themselves a bonus, but they don't want to spend cash from the register because they want the cash flow numbers to look good to Wall Street.
Makes sense.
So instead, they print coupons for free slices of pizza, and they give them to themselves.
Okay. But they haven't used the coupons yet, so I still have my slice.
Exactly. The accounting says, hey, there are still only 8 slices. The pizza hasn't changed. But the moment those coupons are used, the moment those options are exercised, the pizza doesn't get any bigger.
Right.
The pizza just has to be cut into more smaller slices. Suddenly, the pizza is cut into 10 slices. Your 1 slice share now represents a smaller percentage of the whole pie. You have been diluted.
So my piece of the pie got smaller without me actually selling anything.
Correct. And Graham's argument is that companies pretend these options are essentially free. For decades, accounting rules actually allowed companies to not record stock options as a formal expense. They said, well, it doesn't cost cash, so it's not an expense.
But it costs ownership.
It costs you, the shareholder, a percentage of all future profits. Graham argues you must calculate earnings based on all the shares that could exist, fully diluted, not just the ones that exist today. If you don't do that, you are just fooling yourself about the true value of your share.
That makes total sense. If there are 1 million coupons out there floating around, I need to know about them before I buy a slice of that pizza. And it seems like modern tech companies are the worst offenders here.
Oh, they absolutely are. And we will get to the modern context in a bit, but the principle remains. If a company pays its employees in stock, that is a real cost. It is a direct transfer of wealth from you, the existing shareholder, to the employees.
This actually brings us to a general rule Graham has, which I find really refreshing. The simple arithmetic rule.
It's one of my favorite quotes in the entire book. He says, whenever calculus is brought in, or higher algebra, you could take it as a warning signal.
That is just great advice for life, honestly. Someone is using huge words and complex math to explain why they're right. They're usually trying to hide something from you.
It really is. He notes that in 40 years on Wall Street, he never saw a dependable calculation of value that went beyond simple arithmetic. Addition, subtraction, maybe a little multiplication.
Keep it simple.
Right. If a company needs a PhD in math to explain how they made a profit, like, well, we have this derivative structure hedged against a foreign currency swap, amortized over 12 years, they probably didn't actually make a profit. Honest profitability is usually visible through simple addition and subtraction.
So complexity is a massive red flag.
Complexity is almost always camouflage.
That leads us perfectly into the story section of this deep dive. Because Graham doesn't just talk theory, he brings receipts. He has this amazing way of doing a forensic autopsy on companies that blew up.
He really loves a good train wreck, and the first one is literally a train wreck.
Right. Let's talk about Penn Central.
Penn Central. This is a massive story. It's hard for modern listeners to understand just how big Penn Central was back then. Imagine if Amazon or Google went bankrupt tomorrow. That was Penn Central in 1970.
It was that big.
It was the largest railroad in the United States. It was the result of a huge merger between the Pennsylvania Railroad and the New York Central. It was what they called a widow and orphan stock.
Meaning it was considered so incredibly safe you could just put your grandmother's savings in it and never worry.
Exactly. So, setting the scene. It's 1968. Penn Central shares are trading at $86.50.
Which is a premium price.
Very solid. Management reports earnings of $3.80 per share.
So a PE ratio of maybe 23, 24. A bit expensive, but for a solid railroad monopoly, it looks safe.
It looked incredibly safe. Wall Street loved it. But Graham points out this one single line item that anyone could have seen if they just bothered to look at the annual report.
Okay, what was the line item?
Income taxes.
What about them?
They didn't pay any.
Zero.
Zero for 11 years straight.
Wait. If they are reporting huge profits to the shareholders, $3.80 a share, how are they paying absolutely zero taxes to the IRS?
That is the multi-billion-dollar question. And the answer is really simple. The IRS doesn't accept pro forma earnings. The IRS doesn't accept adjusted earnings. The IRS wants a cut of the real cash profit. If a company tells the shareholders we are making a fortune, but tells the IRS we made absolutely nothing, Graham says, believe the tax return.
That is such a simple, elegant litmus test.
It is the ultimate lie detector. Penn Central was using highly aggressive accounting to capitalize costs. They were essentially pretending everyday maintenance expenses were long-term investments so they could show a profit on paper.
So instead of saying, we spent $10 million fixing the tracks, which would reduce their profit, they said, we invested $10 million in track upgrades, which goes on the balance sheet as an asset.
Exactly. They literally turned an expense into an asset, but they couldn't fool the rigid IRS rules, so the tax bill was zero. 2 years later, in 1970, Penn Central declared bankruptcy. It was the largest corporate failure in history at the time.
And the stock went from $86 to what?
Effectively zero. Wiped out. Pension funds, grandmothers, institutional investors, all just crushed. And Graham's point is, you didn't need to be an insider to see this coming. You didn't need a whistleblower, you just had to check the tax line.
That is incredible. Okay, let's move to the next story. This one sounds like a financial engineering nightmare. NVF Corporation and Sharon Steel.
This is one of Graham's most sarcastic moments in the entire book. He calls the accounting here a collector's item.
You know you're in deep trouble when Ben Graham starts getting sarcastic with
Oh, for sure. So here is the setup. NVF was a very small company. They made vulcanized fiber. Very boring industrial stuff. $31 million in sales. Tiny. And they decide they want to buy Sharon Steel.
Okay.
Sharon Steel is huge. $219 million in sales, 7 times bigger than NVF.
It's like a house cat trying to eat a Great Dane.
Exactly. So how do they possibly do it? They can't pay cash. They don't have it. So they use financial engineering. They launch a hostile takeover. They offer the Sharon Steel shareholders a deal. They say, give us your stock, and we will give you these highly complex IOUs, specifically 5% subordinated debentures.
Okay, so they load up the combined company with massive debt to pay for the deal. This happens in leveraged buyouts all the time on Wall Street. What's the specific trick here?
The trick is in how they recorded that debt on their books. Usually debt is a liability. It sits on the right side of the balance sheet and it weighs you down. It lowers your equity.
Right.
But NVF used a gimmick called deferred charges. They actually argued that the cost of issuing this massive debt was an asset.
Wait, I need to make sure I heard that right. They counted their debt as an asset.
In a very roundabout way, yes. They capitalized the expense of the takeover itself. They created an accounting entry that balanced out the liability, making it look like they had way more equity than they actually did. In the end, they created $163 million in new debt against only $2.2 million in real equity.
$163 million in debt on $2 million of equity. That's leverage on absolute steroids. That's like 80-to-1 leverage.
It is a total house of cards. But if you just looked at the headline earnings that quarter, it looked like a genius move because they were suddenly consolidating all of Sharon Steel's revenue into their own.
Wow.
Graham's lesson here is that complex financial engineering almost always hides a lack of tangible equity. If you see a minnow swallowing a whale, check the books very carefully. If the math looks like magic, it's probably a trick.
And finally, we have a story from the modern era, or at least the 2000s era. Jason Zweig updates the book with the story of Lucent Technologies. And this one really resonates because it feels very, very tech bubble.
This is the ultimate .com darling. In the year 2000, Lucent was the most widely held stock in America. Everyone owned it. It was the backbone of the internet.
It was basically the NVIDIA of its day.
It was, and they desperately wanted to keep their insane growth narrative going. The market demanded 20% growth every single quarter. So they went out and bought a company called Chromatus for $4.8 billion in stock.
$4.8 billion. Chromatus must have been an absolute powerhouse.
Chromatus had no customers and zero revenue.
They paid almost $5 billion for a company with zero revenue.
Yes, it was pure speculation. And here is where the accounting gets really funny. How do you record a purchase like that on the balance sheet? You bought assets, right? But they had no physical assets, no factories, no inventory, just ideas and some engineers.
So what did they do?
Lucent booked almost the entire purchase price as goodwill.
Goodwill. That sounds so nice. We paid for their good vibes.
Goodwill is basically the plug number in accounting. It's the difference between what you paid and what the hard assets are actually worth. Zweig jokes that goodwill was the wrong term here. Hope chest was much more accurate. They were just hoping there was value there, but there wasn't.
But Lucent didn't stop there, right? They were also doing something really sketchy with their own customers to boost their sales numbers.
Vendor financing. This is crucial. Lucent was reporting massive sales growth to the street. Look, we sold $1 billion of equipment. But it turned out Lucent was actually lending the money to those customers so they could buy the equipment.
That's like me lending you $10 so you can buy lemonade from my own lemonade stand, and then I go brag to everyone that I made $10 in sales.
Exactly. And then I declare bankruptcy and I never pay you back.
Which is exactly what happened.
You haven't made any money at all. You just moved cash from your left pocket to your right pocket and took on all the risk yourself. When the dot-com bubble burst, those customers, many of them were just shaky startups, went bankrupt. Lucent sales evaporated overnight, the loans went bad, all that goodwill had to be written down to zero. The stock fell from $84 a share to roughly $1.
From 84 to 1, $190 billion of wealth just destroyed. Because people believed the headline numbers and didn't stop to ask, are these real sales or are we buying our own revenue?
It just shows that even the biggest, most respected companies can fall victim to their own hype. They start believing their own accounting lies.
So that is the history lesson. But this is where it gets really interesting for us today, because we're not looking at railroads in 1970 or telecom hardware in 2000. We are in 2026. What does this principle look like right now?
It looks different on the surface, but the underlying mechanism is exactly the same. The railroad bond scams are gone, but we have entered the era of adjusted EBITDA.
Ah, yes. I remember the WeWork IPO filings a few years back, where they literally invented a metric called community adjusted EBITDA.
Which was basically earnings before all the actual costs of running the business. It became a massive punchline. But today, the big one in the tech sector, and this affects almost every major company in the S&P 500, is stock-based compensation, or SBC.
This connects right back to the dilution point Graham made with the pizza analogy.
It is a direct line. If you look at almost any major tech company today, especially the high-growth software companies, they report two different numbers. They report GAAP earnings, the official number, which often show a loss or maybe a very small profit. And then they report non-GAAP or adjusted earnings, which show a huge profit. The biggest difference between those two numbers, they subtract the cost of paying their own employees in stock.
Their argument is always, well, giving stock to employees isn't a cash expense. We didn't write a check, so it shouldn't count against our cash flows.
Which is technically true. No cash leaves the bank account. But remember the pizza. It dilutes the shareholders. It is a very real cost to you, the owner. If a company issues 5% more stock every year to pay its engineers, your share of the future profits drops by 5% every year.
Right.
Graham would look at these non-GAAP numbers today and say, you are ignoring the fact that you are giving away a piece of the company every single year.
So I'm looking at a tech stock today, and the adjusted earnings are huge, but the real earnings are negative. I really need to check how much stock they are printing.
Absolutely. You have to treat SBC as a real expense. If you don't, you are vastly overestimating the profitability of the business. You're valuing them based on a total fantasy where highly skilled labor is somehow free.
There's another modern trend I want to ask you about, the restructuring charge. We have seen mass layoffs in the tech sector over the last few years. Companies firing 10 or 20% of their staff.
This creates a really fascinating accounting dynamic. A company announces a massive layoff. They take a huge one-time charge for severance and restructuring. That quarter, their earnings look absolutely terrible. But they tell Wall Street, hey, ignore this, it's a one-time thing.
And then the very next quarter.
The next quarter, their ongoing costs are way lower because they have fewer employees. Their adjusted earnings suddenly pop, and the stock usually jumps.
It feels like a hack. Like they're being rewarded for failure. We hired way too many people. Oops. Now we fire them, take a charge, and the stock goes up.
It really can be a hack. The question you must ask is this actually a one-time event? Or is this company trapped in a cycle of hiring too many people, then firing them, taking a charge, and pretending it's extraordinary? If a company is restructuring every 2 years, that's not an event. That's just bad management. That is a clear sign of a volatile, unstable business.
And finally, on the modern landscape, SPACs, special purpose acquisition companies. We saw a massive boom and bust of these recently.
SPACs are the direct spiritual successor to the warrants that Graham hated so much. A SPAC is essentially just a pool of cash with a massive amount of founder shares or warrants attached to it. The sponsors, the insiders who set it up get free upside. They get shares for pennies. The retail investors put up all the real money.
Okay.
When the deal finally happens, the sponsors severely dilute the retail investors.
So the sponsors win no matter what, and the retail investors take all the risk.
Precisely. Graham's quote about warrants being a potential disaster could have been written about the SEC bubble of the early 2020s perfectly. Most of those companies are now trading 80 or 90% below their offering price.
It's the exact same greed, just in new packaging.
The packaging changes over time. Human nature does not.
Now, I do want to push back a little bit here, because Graham makes this sound, doable. Just look at the task line, just check the footnotes. But have you actually seen a modern 10K filing?
They are absolute beasts. They are weapons of mass distraction.
They are thousands of pages long. The footnotes have their own footnotes. Can a regular person, a defensive investor, actually do this level of forensic analysis?
That is the most important limitation of this lesson, and we have to be honest about it. Graham, later in his life, and certainly most experts today, would admit that the level of forensic accounting required to catch a cleverly designed modern fraud is just beyond the average retail investor. Even professional short sellers spend months and months digging into these things with teams of analysts.
So if I try to do this myself on a weekend, I might just confuse myself.
A little knowledge is very dangerous here. You might see a change in accounting policy and screen fraud when it's actually just a standard, boring update required by the SEC. Or worse, you might miss the fraud entirely because it's buried in an unconsolidated subsidiary's balance sheet in the Cayman Islands.
So what's the real risk here for the listener?
The risk is false confidence, thinking you are Sherlock Holmes when you haven't actually been to detective school. For the defensive investor, the person who just wants to safely save for retirement, trying to be a part-time forensic accountant, is probably a really bad use of your time.
There is another limitation too, specifically regarding growth. Graham was very, very focused on tangible assets, factories, trains, physical inventory. But what about a modern company like Amazon?
This is where Graham's strict, simple arithmetic test really struggles. For years and years, Amazon recorded nothing but losses. They spent every single dollar they made on building out warehouses, data centers, and the whole prime infrastructure.
If you used Graham's strict earnings test on Amazon in, say, 2005, you would have run away screaming.
You absolutely would have. You would have looked at it and said, they have no earnings, they are diluting shareholders with stock options, it's a disaster. But in reality, they were building massive, unprecedented value. The value was just in the intangibles, the network effect, the market dominance, the customer loyalty. It just wasn't showing up in current net income yet.
So Graham's deep skepticism is a bit of a double-edged sword. It definitely protects you from fraud, like Penn Central.
Yeah.
But it also screens out the genuine high-growth innovators who are heavily investing upfront for the future.
Exactly. It is a tight filter that catches all the trash, but it also occasionally catches the rocket ships.
Yeah.
You have to decide if you are okay with missing the rocket ships to ensure you never buy the trash. Graham's entire philosophy is, I would much rather miss a gain than suffer a permanent loss.
That brings us to the debate angle for today. Because this isn't just about accounting rules, it's really about philosophy. There's a real argument happening on Wall Street right now about non-GAAP numbers.
The adjusted earnings debate, it really is the central conflict of modern finance.
On one side, you have the Wall Street view. Let me play devil's advocate here for a second. They say, look, the official rules GAAP are completely outdated. They were written for the industrial age. They force us to count non-cash things like goodwill impairments as huge expenses. If we write down the value of goodwill, no actual cash left the building. Why should that hurt our reported earnings? Adjusted numbers show the true underlying cash-generating power of the business.
And honestly, that is a valid argument in some specific cases. If you are analyzing a modern software company, standard accounting doesn't always capture the unit economics very well. Depreciation of a massive server farm is very different from depreciation of a 19th century steel mill.
But then you have the Graham view.
The Graham view is entirely unforgiving. Every adjustment is a potential lie. If you give management the discretion to decide what counts as a real expense and what doesn't, they will always decide to make themselves look more profitable. They are not neutral, objective observers. They have huge bonuses on the line. They have their egos on the line.
Graham would basically say, I'd rather rely on a rigid, imperfect rulebook than on the CEO's personal opinion of his own performance.
Exactly. And he would immediately point right back to Lucent. Remember, Lucent essentially said, we're lending money to our own customers, but it's fine. Look at our adjusted growth. The rigid rulebook would have said, you have negative operating cash flow. The rigid rulebook would have saved your entire portfolio.
So the question we leave for the listener to wrestle with is, who do you actually trust to define profit? The dusty, old, rigid rulebook, or the guy in the nice suit who desperately wants his stock options to vest this quarter?
I know exactly who Graham trusts. He trusts the cynic. He trusts the tax man.
Me too. Okay, let's wrap this up with something truly actionable. We've covered a lot of scary stuff today: manipulation, fraud, massive dilution. But the listener is sitting there thinking, what do I actually do with my portfolio on Monday morning?
We can boil this down to a few very concrete steps. Let's call it the Graham rule for earnings.
Step 1.
Step 1 is simple. Ignore the quarterly headline entirely. Never buy a stock just because they beat expectations this morning. That number is pure noise. It's manipulated. It's a game played between analysts and CFOs.
Okay, that's freeing. Ignore the noise. What do I look at instead?
Look at the long-term average. Graham specifically suggests looking at the average earnings of the past 7 to 10 years.
Why such a long time horizon?
Because manipulation is really hard to sustain for a full decade. You can fake a quarter. You can fake a year with a big bath. You cannot fake 10 years. An average smooths out all the one-time lies. If the CEO goes on TV and says, we had record results, but the 7-year average is totally flat, trust the average. It tells you the structural truth of the business.
That's great advice. It slows you down. It forces you to look at the massive trend line, not the daily blip. And finally, what was that quick sniff test?
The tax provision. Just like the Penn Central story. Pull up the income statement, find the line that says income tax provision.
What if it's 0?
If they say they made $1 billion in profit to shareholders, but the tax provision is 0 or tiny, ask yourself why. Now, there might be a legitimate reason, maybe some weird tax credits or past losses being carried forward, but often it is the smoke that indicates a massive fire. If they aren't paying taxes, they might not actually be making real money.
If the IRS doesn't want to cut, maybe there's nothing to cut.
Words to live by.
This has been a fascinating look under the hood. It makes you realize that the numbers we see flashing in green and red on the screen are really just the beginning of the story.
The numbers are just the start of the investigation, not the end.
That was lesson 12 of 14 on The Intelligent Investor, the definitive book on value investing. Subscribe for the full series. If you haven't seen our debate overview of the whole book, check that out, link in the description. Thanks for being here. See you next time.